All right, gang, we're going to take a look at some very straightforward examples to see if you remember whether they're includable in income or whether they can be excluded from income. In this first one, you were on a game show and you won. You won a brand new car. Does that become includable or can you exclude it because it was a game show? You got it. We have to include it. And by the way, remember our rule? If something is taxable, you always tax the fair market value of it. That's absolutely right. We're going to tax the fair market value of that item. Let's take a look at our next example here. A guaranteed payment received by a partner as compensation for services rendered. Guaranteed payments. To the partner receiving it, it's absolutely income. And then to the partnership, it's like a salary, right? They can expense it to arrive at net income and then spread the net income between the partners on their profit and loss sharing ratio. So the guaranteed payment to a partner, whether it's for salary or even leaving your capital in there and having interest income and interest expense, that's also going to be includable in your income. Health insurance. Your boss gives you a great health insurance plan and they pay the entire premium. You don't have to pay a penny. That's a fringe benefit, isn't it? And you get that, and it's excludable from your income. The boss gets a tax deduction for it. You don't have to pick it up in income. But remember, by the way, if you're self-employed, you can take the expense for all your employees' health insurance. But your own health insurance, that's an adjustment on the front of the return, not a subtract on the business Schedule C. Our next item. Wow. That is some burger she's chewing on there, huh? Well, the thing is, they're making everybody work late. And to keep them happy and keep them fed, they buy them dinner. You know, the proverbial 2 boxes of pizza and a whole bunch of soda. Do you have to claim that as income? No. If it's for the convenience of the employer, it is excludable from income. So this is the classic example of that. So it's excludable. State tax refund. And in the prior year, you took the standard deduction. Remember, the way the examiners will often say that is you filed a 1040A. In a 1040A, you're taking the standard deduction. You can't itemize on that. You have to use the full 1040. So in this case, it was not a deduction, an itemized deduction, when you paid your state taxes in the previous year. Now that you got a refund of it in the current year, related to last year because you overpaid and finally they gave you the money back, it's excludable from income. But let's play a little game here. What if you had itemized last year? If you had itemized last year and it had been a benefit, well, then you took it as a deduction going out. So you paid your governor, your state taxes, and you took an itemized deduction on your federal return. The governor returned some of the money and said you paid too much. Well, getting it back becomes a taxable event. Now, I did make one little interesting comment. I said, assuming you got a tax benefit. If you had taken it as an itemized deduction, then when it comes back, it's income. In this fact pattern, it said, no, it was a freebie last year. You used the standard. Well, then it was nothing going out. It's nothing coming back. All right, this next example says interest from a series EE. If you remember, I gave you a little memory tool. EE stands for educational expense, right? That's the way we think of it. You put money into a savings bond. The savings bond is going to earn interest excluded from income if your level of income is low enough. And as long as you use that money to pay for the kid's education or some family member's education, that interest is always excludable. But in this case, you cashed it in not to pay for education, but to buy a brand new car. Guess what? Sorry, gang, that's not going to be excludable. That interest is now includable in your income. We have an individual who's 60 years old and he receives a distribution from a Roth IRA. Now remember, a Roth IRA means that you pull everything out, principal and interest, and they're both excludable from your income. The disadvantage, of course, was when you put the money in, you didn't get an adjustment. You couldn't subtract it. But a lot of people are willing to do that. If you put it in and you've let it sit there for 5 years, and you pull it out after the age of 59 and a half, you've pretty much got a tax-free withdrawal of your IRA from a Roth. So in this case, they say that he put it in 6 years ago. He's now over 59 and a half. He's 60 years old. He can pull it out of the Roth, and it's 100% excludable from his income. Ladies and gentlemen, you now know all the items that you should include and exclude.